Do you want to know about different types of trades? What is import, what is export, what is wholesale trade, what is retail trade, and all? Well, I am here to explain all these things in a subject called Organization of Commerce and Management in a very simple way and in a very interesting way. So, watch this video till the end. Hello friends, I am Darshan Gala and today we will learn about the second chapter of OC, trade. So we already know that economic activity is an activity in which it involves production, distribution and consumption of goods and services in exchange of money, right? Now let's understand the meaning of trade. Trade simply means the process of exchange of goods and services. For example, when we buy any product from shop in exchange of money, so it is called trade. So in it we establish a link between buyer and sellers. Like shopkeeper is seller and we are buyers. So in this chapter we will learn the types of trades in detail. So there are broadly two types of trade, internal trade and external trade. So we will first understand about the internal trade and its components. The meaning of internal trade. Internal trade simply means the goods and services which are purchased and sold within the country. So it is referred as internal trade because it is traded in same country in within our country. For example, purchasing goods from the door, salesman, local shop, exhibition, regional markets, or any mall, etc. So, for doing internal trade, there is a channel of distribution. So, there is first there is producer or manufacturer which produces any product, and then it gives to wholesaler. Then wholesaler sells it to retailer, and retailer sells it to customer. So, there is whole channel of distribution. Now, in internal trade, there are mainly two types of trade, wholesale trade and retail trade. Meaning of wholesale trade: when goods are purchased in large quantities from the manufacturer or producer for the purpose of resale to retailers, it is known as wholesale trade. Any person who is engaged in wholesale trade is known as wholesaler. Wholesaler buy goods from manufacturer and then sell it to retailers. So, wholesaler is a buyer and as well as seller. He is both. So, wholesaler may perform different functions in the process of distribution of goods and services. It enables the producers to reach the consumers. So, it's a link between manufacturer and retailer. Now, let's understand the features of wholesaler. A wholesaler purchases goods from the producer in large quantities. Wholesaler has to take risk in the process of distribution. So, wholesaler takes the risk that will the retailer buy from the goods from him or not. So that is the risk of wholesaler. Wholesaler deals with one or few types of goods because he is dealing in very high quantity. So he may keep the different. He may not keep the different kind of goods. He may prefer the only one type of goods or few kind of goods. Fourth is a large amount of capital is required in this business. Of course, there is a requirement of large capital because it's a wholesale business, so quantity is required to buy. High quantity is required to buy. A wholesaler maintains price stability by balancing supply and demand factors. The manufacturers can get direct information about market through wholesalers. So the manufacturers can get information like wholesaler will tell about the demand, how much retailers are ordering the product. So manufacturer can accordingly manufacture the product according to market demand. Seventh is wholesaler sells the goods to retailers as per their requirements. So retailers will tell a specific quantity like 100 quantity, 200 quantity. That much quantity only wholesaler will sell. Eighth is wholesaler performs the marketing functions like assembling, warehousing, transporting, grading, packing, advertising, and financing. So these are the activities which are performed by wholesaler. If we take any example of wholesaler, there are many kinds of agency like agency of Haldiram. So Haldiram agency is known as wholesaler, which supplies to various kinds of shops its product. Now let's understand the retail trade. What is retail trade? When goods are sold relatively in small quantity to ultimate customer by a wholesaler or distributor or dealer is known as retail trade. So if for example a person who has started his small shop and order the products from wholesaler and directly sells to the customers, it is known as retailer. Features of retailers. Retailer is the link between the wholesaler and consumers. So it's the end component. He operates in local markets. He has shops in the main market. Retailers deal in wide variety of goods and goods in small quantity. As there will be many kind of customers who would require many types of products. So retailer need to keep a variety of goods in his store. For this investment requirement is limited. Very small amount of capital is required for initiation of business. Fifth is less risk and low amount of profit as compared to wholesaler. So there is low investment required. Also there is less risk, so the profits will be small. In retailers, there are two types of retailers. First is itinerant retailers, that is hawkers, peddlers, street traders, cheap jacks, market traders, etc. And another type is fixed shop retailers. So in fixed shop retailers, there is small scale fixed retailers and large scale fixed retailers. In small scale fixed retailers, there are general stores, second hand good shops, authorized dealers, specialty shops, and in large scale dealers there comes departmental stores, supermarket stores, chain stores, malls, etc. Now let's understand the itinerant retailers one by one. Components of itinerant retailers. First is hawkers, in which they carry the goods in handcart and move from city to city. Second is peddlers, which carry the baskets on their head and contain fruits, vegetables, etc. There are street traders. There are cheap jacks. Cheap jacks means they have temporary setup. Means they set up their shop temporarily with the help of some curtain or tent. Market traders open their shops on market days on different places on fixed days. For example, there is Monday market, etc. Now let's understand the fixed shop retailer. So in fixed shop retailer, there is small scale fixed shop retailer and there is large scale fixed retailer. So in small scale retailer, there comes general stores, which are like food grain, stationery shops, medicine shops, etc. Second hand goods shop means they purchase and sell used goods. For example, the dealing in books, furniture, TV set, clothes, cars, etc. Authorized dealers, these retailers have authorized dealership of particular manufacturers goods. They deal in goods like TV sets, washing machines, automobiles, music systems, etc. They have authorized agency of the company, so they are authorized dealers. Specialty shops, shops, for example, some sports material, some unique dresses, leather goods, watches, books, etc. So they are specialty shops. Now let's see the large scale fixed retailers. First is departmental store. So departmental store is a large scale retail shop having different departments under one roof. Each section deals in particular type of goods. For example, shopper stop, big bazaar, etc. So now let's understand the features of departmental stores. Uh, uh, there is a shopping convenience. Means you can get any kind of goods in one roof and has different types of price levels. Second feature is centralized management. The whole management is centrally owned, managed, and controlled by any one independent entity. Third is wide variety of goods. You can get a wide range of goods and services of different types of brands, colors, designs, etc. Fourth is specialization. Each department sections deals in separate line of product or goods with specialized services. For example, electronics section has mobile laptops, etc. And in kitchen section there is household things. Fifth is central location. The departmental store prefers central place of the city, so the location becomes easy for customer to access. For example, any departmental store will be near station or at the place where everyone can reach easily. Sixth is huge capital. Departmental store requires large capital investment. The capital is required for spacious place storing of variety goods, salary to staff, advertisement, electricity, etc. So there is indeed a requirement of huge capital. No credit facility. Seventh feature is no credit facility. Departmental stores work on cash basis or they accept credit cards but do not offer any credit facility. So we cannot get the goods and pay later. Second is supermarket shop. So supermarket basically is a large retail organization which mainly sells a variety of food and grocery on the items on the basis of self service. Supermarket is a large retailing shop where goods are kept on open racks. Buyers have to select products, place them in the trolley or a box, bring them near the gate where the clerk prepares the bill on the counter for the goods selected. The buyer pays the bill and takes delivery of goods. So this is particularly supermarket in which we can get products, grocery, mainly groceries at very low price. For example, DMart, Reliance Price, etc. Features of this supermarket shop: first is location. They are generally located in the central location where there is population concentrated. Second is types of goods. They mainly deal into day-to-day requirement. For example, food grains, bakery products, groceries, stationery, etc. Uh, Self-service. So supermarket operates on self-service style. Like there are no salesmen and salesmen in the shop. The customers can select the goods from the information printed on the products. Fourth is reasonable prices. As supermarket buys on large scale, they pass on the benefits to the customers by selling the goods at reasonable prices. So in a supermarket buys in very bulk order. So there is some discount to him, so he can afford to give discount to customers also. Fifth is capital. Supermarket shop requires huge capital. For example, any supermarket will buy or rent a huge land, and there he can set up his whole supermarket. Sixth is cash sales. Goods are sold only on cash basis. No credit is given. Seventh is attractive packing. Packing plays important role in selling product in supermarket. Goods are duly packed by giving details of quantity, quality, say weight, price, and etc. Eighth is impulsive buying. Customers get induced to buy unwanted items just because of attractive packing and sales promotion schemes. So anyone who enters who enters the shop with intention of buying products of 1,000 rupees, he will end up buying 5,000 rupees due to such kind of offers and packing and attractive packing and sales promotion schemes. Third is chain stores. Chain stores are retail stores owned by a single organization. Chain store is a network of number of branches situated at different localities in the city or different parts of country. For example, Bata stores. So in the Bata store, you can see each and every in each and every town and city. For example, Vijay Sales, Raymond stores, etc. These are the examples of chain stores in which you will see the same kind of shops, same style of managing the products, and same kind of employees wearing the uniform, wearing the same uniform. Now let's understand the one price shop. The shop where the prices of all products or goods are same is known as one price shop. For example, a shop selling goods for rupees 49, rupees 99 or rupees 199. Features of one price shop: uniform price. All goods whether big or small in size are sold goods at one standard fixed price. There is no scope of bargaining. Second is low price. Usually the price of goods are reasonably low. Third is variety of goods. Shops usually deal in variety of small sized goods like stationery, toys, fun games, cosmetics, etc. Fourth is location. The shops are located in busy centers in the city, such as busy trade streets near railway stations, bus stops, etc. Cash sales. In this kind of shop, goods are sold on cash basis only. No credit is allowed. Sixth is less capital. Due to small goods, these stores require less amount of capital. Now let's understand the mall concept of mall. A mall is a large enclosed shopping complex containing various stores, businesses, and restaurants. A modern shopping mall is an American term in which one or more buildings form a complex. It is a modern type of shop which enables customer to buy different products from one unit to another units of mall. For example, Phoenix Mall, Inorbit Mall, RCT Mall, etc. Now, a recent trend in retail trade. So nowadays we all know that online retail is booming. So we usually buy anything we want from Amazon and Flipkart. So this kind of online trade are in a booming period. So now, after understanding the whole internal trade, now let's understand the concept of external. First is export. Export refers to sales of goods and services to foreign country. For example, we sell any product to US. In the export, there is a proper procedure. So we will understand the whole procedure. There are four stages. First stage is preliminary stage, in which there is registration and appointment of agent. So the exporter has to get himself registered with the various authorities, and then he has to get the appointment of the agent who can sell his product, who can basically book the order and sell to the foreign country. Second stage is pre-shipment stage. So in that, receipt of order, as soon as the order is received, the exporter must verify and confirm the order. The exporter checks on the restriction on import in importer's country. Second is letter of credit. The exporter requests importer to issue a letter of credit in his favor. The received letter of credit from importer's bank will clear the foreign exchange and other restrictions. So letter of credit means the exporter will become safe. For example, letter of exporter will ask the foreign bank, like importer's bank, to give the letter of credit that he will give the money of the goods. So he cannot default and deny the money for the goods. So letter of credit is the kind of assurance for the exporter. Third is pre-shipment finance. The exporters obtain pre-shipment finance from his banker to meet working capital requirement. There is a lot of working capital requirement, so he gets it from his bank. Fourth is production. Fifth is packaging. Sixth is ECG, cover, export credit and guarantee corporation. So ECGC means the exporter may obtain cover from ECGC. Such cover protects exporter against credit risk. For example, if importer fails to make the payment of the bill, the exporter can cover from ECGC to extent of the 90% of his loss. For example, he incurred a loss of rupees 100, so he can cover the 90 rupees. Seventh is GST formalities. The exporter needs to complete GST formalities regarding export trade. Eighth is marine insurance. The exporter has to obtain marine insurance under CIF, cost, insurance and freight contract. He has to pay necessary insurance premium and obtain insurance policy, so he can get his goods safe if ship sunks in the river, in the ocean, or anything happens to his goods. So there is kind of marine insurance in which he can insure his goods. Ninth is C&F agents, clearing and forwarding. In export trade, C&F agents are known as custom house agents. These agents are responsible for forwarding the goods. After this, there is third stage, shipment stage. In shipment stage, processing of document is done. Then examination of goods is done. After that, loading of goods is done. After that, fourth stage is post-shipment stage. Post-shipment stage involves shipment advice, presentation of documents, realization of export incentive, and follow-up. Now let's understand the import trade. Import trade refers to the purchase of goods and services from foreign country. For example, if we need any product, if we need any technological product or anything, we can buy it from Japan or US or any country, etc. So now let's understand the whole import procedure. So there is first stage, preliminary stage. So in preliminary stage, registration is done. The importer has to get himself registered with various authorities. Second is negotiation. The importer must hold negotiation with overseas suppliers regarding price, delivery, credit period, terms and conditions regarding sale, payment and delivery. For example, we are getting the product from Japan, so we will negotiate the price of goods. We will negotiate the credit period and everything. Second stage is pre-import stage. Pre-import stage means what is this? It includes quota certificate. Certain items are subjected to quota restrictions. The importer needs to obtain import quota certificate from government authorities. Second is foreign exchange clearance. There is foreign exchange clearance in it. Third is order placement. We have to place the order. Fourth is letter of credit, same as we saw in the export. Fifth is C&F agent. Sixth is shipment advice, same as we saw in the export trade. Now third stage is import stage. Receipt of document, bill of entry, delivery order, custom clearance, etc. These are the process. Last stage is post import stage, in which there is port trust due, custom duty, insurance premium, freight payment, exporter payment, follow up. So these were the import and export. Other than import export trade, there is interport trade. The term interport trade is historically referred to a seaport or warehouse where goods would be imported for storage or purpose before re-export. It also refers the practice of re-exporting goods or without processing repackaging them again. For example, we India if India is importing raw material from South Africa and then directly selling to Japan. So from outside seas only there is selling process done. So there is no import in the country. There is re-export procedure. So this was the short explanation of chapter 2 trade. Please go through the whole textbook and also go through the differences between various retailers, wholesale trade, retail trade, stores, import export, etc. If you cleared the concepts well from this video, please share to your friends.